Most people looking for passive income from the stock market go straight to individual dividend stocks. And on the surface, that makes sense. You find strong companies like Coca-Cola or AT&T, buy shares, and collect a steady stream of income. But here's the reality: in 2025, picking dividend stocks manually is more risky and less effective than ever. That's why I'm choosing SCHD, the Schwab U.S. Dividend Equity ETF, over most individual dividend stocks. In this video, I'm going to break down exactly why SCHD is beating most dividend stocks this year, and how it can simplify your investment strategy while building wealth faster and more reliably. Let's start with the problem most dividend investors face. Stock picking takes time, research, and often leads to underperformance. Even strong brands like Coca-Cola or Verizon can end up lagging behind broader ETFs like SCHD. Why? Because when you invest in one company, you're exposed to its specific risks: competition, sector weakness, poor management, or dividend cuts. SCHD solves this by holding 100+ high-quality dividend-paying U.S. companies in one fund. These are companies with strong balance sheets, consistent earnings, and a 10+ year history of paying dividends. Instead of betting on one company, SCHD gives you instant diversification and built-in quality control. Now let's put SCHD head-to-head with some popular dividend stocks. First up, Coca-Cola. Coca-Cola is a dividend aristocrat, meaning it's raised its dividend for 25+ consecutive years. But over the last decade, its total return, including dividends and price growth, has been relatively flat. From 2013 to 2024, KO has averaged about 7 to 8% annually. Compare that to SCHD, which over the same period returned around 12% per year on average. That's a massive difference in compounding over time. Next, let's look at AT&T. AT&T was once a favorite among dividend investors, but in 2021 it slashed its dividend, catching millions off guard. Meanwhile, SCHD has continued increasing its dividend and growing its price. Verizon is another high-yield stock investors look to, but it's faced stagnant growth and competitive pressures in the telecom space. SCHD doesn't rely on one sector; it pulls from tech, healthcare, consumer staples, and more. This balance helps stabilize returns and reduce the risk of dividend cuts. Now let's zoom out and look at total return. When we compare SCHD to these individual dividend stocks over the past 10 years, SCHD wins on almost every front: higher average annual return, lower drawdowns during corrections, better long-term dividend growth, and here's the best part: SCHD requires no individual stock research. No need to read earnings reports, chase yields, or time the market. Just buy, hold, and let the ETF do the work. You also benefit from SCHD's screening process. Each year, it selects stocks based on financial strength, return on equity, dividend sustainability, and more. So it's not just high yield, it's high quality. And don't overlook tax efficiency. When you own multiple stocks, you may end up with capital gains distributions, partial sales, and unpredictable taxes. With SCHD, you get simplified reporting and minimal turnover. At the end of the day, you could try to build your own dividend portfolio by buying 20 or 30 individual stocks. Or you could own SCHD and get similar, often better, results with one simple holding. Now that doesn't mean all individual stocks are bad. But if your goal is long-term dividend income with peace of mind, SCHD has proven itself to be one of the top performers in 2025. Personally, I'm continuing to buy SCHD this year and beyond. It's diversified, consistent, and built for wealth building. Subscribe to Asset Index for more deep dives on dividend ETFs, smart investing strategies, and long-term income planning.